Good afternoon, everybody. Today is Wednesday, the 22nd of June, 2011. This is Brian Shannon from Alpha Trends. Let's take a look at this market here. As I had indicated on Twitter, it looks like now we've got a declining 20-day moving average that might be acting as resistance here. We also, look at this and whether you believe in technical analysis or not. There's a lot of people that, think, oh, technical analysis is reading tea leaves and, that people are trying to make these predictions based on certain patterns and that sort of thing, and that's a little bit about what technical analysis is, but it's more about being aware of key levels in the market. And if you just kind of look at it that way and say, here's where the odds may favor a long or a shorter. Here's where I want to study my holdings because, for instance, we have this prior little support area that's been troublesome at the 130 level. So support acting as resistance over here. We've got a declining 20-day moving average in that 130 area as well. If we take a look at it and say these are key levels, and we have to look at the overall direction of the 10, 20, and 50-day moving average, the 20 and 50 in particular are heading lower, the direction of those moving averages and the key points on the chart. So we bounced from really pretty much the lows from March and within a few pennies of that 200-day moving average. Monday, of course, we gapped a little bit lower, and week to date, this is the action in the market. So this is Monday, Tuesday, and Wednesday. We're looking at 3-minute candles here, but we're slightly below the average price for the week. So it says the sellers are in control this week. If you take a look at the 30-minute time frame, we've got this big level up here at 130. The market gapped up yesterday and ran really nicely, throughout the day. And then, for instance, yesterday afternoon in my chat room, people were saying, "Well, should we? What do you think about taking longs home?" And my answer was that if you had a good price on your long positions and you've taken some of the profits off, then maybe you could take a little bit home. But it didn't make sense to be buying new positions near the close as the market was approaching what was the potential for, and which has now turned into some resistance in the near term. So 130 is a big level for the S&P 500 right now. If we continue back down, 128 was a big level. We were focused on that last week. We gapped up through it yesterday. Now I think that we want to observe how the action is down near that 5-day moving average, down near that 128 level. But when we look at the bigger picture, it's really, we're in a downtrend here, and look how well the 20-day moving average held on the way up. There's a possibility that that 20-day moving average can turn into resistance, and we continue down through the 200-day moving average in that. Best case scenario for this market in the near term, I think, is that we kind of chop around, go sideways a little bit, and perhaps even build onto this 130 level we could see as an inverted head and shoulders pattern possibly forming if we get a higher low near that 128 level. So if we can come down and find some support near 128 and that turns into a higher low, then maybe the market's going to build enough energy to push past this neckline of 130 and up towards that 50-day moving average for the next for another push higher. I'm not looking for it. I'm not expecting it. It's a scenario that I'm thinking is possible. Before it could do that, though, it's got to prove itself. It's got to come down and hold above this prior resistance. And technical analysis and in any analysis in the market it's a moving target, and you choose your time frame to engage on. And for a lot of people, the proper thing right now continues to be sidelines and cash. We've had a couple days of reprieve for the bulls this week, and it feels good to make money on the long side, but it's really tough to trust any follow through when we're in a downtrend, and that's what we have on the daily time frame with a declining 20 and 50-day moving average. There's always exceptions to the market. On the way up, there were some stocks that were just getting hammered every day. on the on the way down in an unhealthy market for the bulls, then we've got some stocks that do manage to continue to follow through on their breakouts and that sort of thing. But it's about probabilities. Are the probabilities there for breakouts and follow throughs? And the answer is no, not well. The overall trend is down. Not well. We have negative breadth when we see at the end of the day, the market was holding pretty good, and then we're not going to raise the debt level and that sort of thing, and people started deciding to sell. The advanced decline line, we ended up with 1,780 decliners and 1,220 advancers. So there's still a lot of pressure on this market. On the 1 minute time frame, it was basically when we broke the VWAP this afternoon and made that lower high that we continued lower. I pointed out this 3-day or volume weighted average price for the week, and there's no magic support there. It was just a level to keep an eye on, that if you were short into the close, that maybe you wanted to watch the action near that area. There are no magic numbers in the market. It's not a magic Fibonacci. It's not a magic moving average. A lot of times those things will, in hindsight, turn out to be what looked like the real holy grail, and sometimes you get an advantage based around an oscillator, an indicator, a moving average, or whatever. But technical analysis is a tool that allows us to say, what's the overall market environment that we're in? What are the odds for longs? What are the odds for shorts? How aggressive do I get? Where do I put my stops? Do I get aggressive because I think it's going to break out past 130? Not while we have a declining 20 and 50-day moving average. You don't. If we were above if we were looking at it back here, this is where you want to look for breakouts, and it's not just hindsight. This is where you want to look for, hey, these markets are going to break down. Some stocks that, look sometimes the stocks look vulnerable and then they continue higher. So, a lot of the solars had some strength today. They were looking pretty ugly though, and for particular like this JKS, it was looking like, I was telling subscribers last night, if we get this stock down below some of this, below yesterday's low, that this could be a good continuation to the downside. But, that's what we anticipate. If what we anticipate doesn't ever, even become realistic at all after the market is open the next day, then you watch it go higher, and you look at it and say, hey, I'm glad I didn't take that trade. I was waiting for price confirmation to get short and possibly continued some downside action on this chart. But the point is that, again, we're not trying to predict so much as just anticipate what are the key levels and what would motivate the majority of people, and we want to kind of tie that in with moving averages, with key prior levels of support or resistance. We've got a really ugly looking NASDAQ that's basically right on its 200-day moving average here again, and that's as I pointed out in last Wednesday's show, those 200-day moving averages, sometimes they act perfectly and we get a beautiful bounce off them. Other times we chop back and forth above and below, and that's what we're looking at right now, is that in the NASDAQ we're getting a lot of choppy action over the last week and a half near the 200-day moving average. Apple is getting choppy action near that 200-day moving average. It hasn't been below its 200-day moving average since where was it, back in right here, which was, I guess, April of '09. So it's had a real nice run, and now it's kind of is that 200, is this prior support in here going to be strong enough resistance to continue to send Apple lower? Apple can be a tricky stock, and a lot of people get emotionally attached to it, but it's just another stock, and it's another stock, and it's arguably one of the most profitable, I guess, companies there is, and that sort of thing. But listen to price action. The price action has stunk in here for the last several weeks, and really for most of the year. We had an initial spurt that kind of put us into what's become a bigger range of 320 to 355, 360 basically, and we've just probed the bottom end of that range, and we get false movement around those ranges as well sometimes. But let's take a look at the Russell 2000. It's at $80 a share basically, and came up to what was a prior important support level near this 81. 81 and a quarter-ish area. We've got a declining 20-day moving average, and we're back below it here today. So it looks like this prior important support level is now acting as resistance. We drill it down to a 30-minute time frame. The Russell looks a little bit better than some of these other markets. So for instance, what I've been talking about is this $79.60 level has been somewhat kind of what you would what I would equivalent with the 130 level in the SPY. So the Russell has kind of outperformed here a little bit, and that's been somewhat encouraging. What we want to see for the Russell, if this market is in fact in the recovery process if it's in a recovery process, then we want to see that 79.5 basically holds. The daily chart doesn't suggest it will. We probed the low end of the year range down at that 77 level. Maybe this market just needs to kind of turn sideways a bit, go down and test that 200-day moving average a little bit more, and nobody has the fog-free crystal ball. The market is giving us new information in terms of macroeconomics to earnings to just supply and demand that we have to put into our analysis moment by moment, and it's not easy. It's not always clear, and that's what stops are for. That's what you look at this market and say, well, is this 3-day or volume weighted average price week to date going to hold a support? Is that the important level, or should we be more focused on let's see what happens down near about 79.50, because that's a prior resistance area and a rising 5-day moving average? The semiconductors were down a little bit here again today. This group has been flirting with its 200-day moving average. It undercut the lows from March, and it's trying to find some stability is really the best case that you can make for this. There's nothing bullish about this. It was appearing that, hey, we're getting a little bit of upward action, but you just cannot trust it when we have these declining moving averages. The markets are going to correct one of two ways, or both ways. They're going to correct price-wise maybe first, and then go sideways through some time, and then maybe they're going to break this bigger level. So I think that we're beginning to show some signs of stability at prior important levels and these 200-day moving averages. But it's not enough to hang your hat on. It's not enough to say, okay, I'm going to make a bullish stand here. All longs in this case, market index longs in particular, I think should be considered rentals. They're not. I don't think it's time to build a position unless you're Fidelity, and you have to buy 100 million shares to have a meaningful position of the SPY. You have to leg into it. For people listening here, I think that the majority of you don't have to feel like you're legging into a good trade. The market will give us more evidence that it's becoming healthy when it matters, but it's not there now. So let me just talk about some of the stocks that I had, or actually, you know what? Let me talk about the retailers. Not a lot of people have spent a lot of time talking about the retailers. I have, since they broke out here, and for some reason, I think they have a little bit more. Have been leading in the past 6 weeks in particular. They broke the 50, 100, 150, and 200-day moving average first. They bounced from there first. If you look at the 30-minute time frame, similar to the Russell 2000 at the IWM at 79.50, this RTH, the retail index, broke some resistance here, and it's in a critical area right now. I think back below 106, then this rally attempt is just that, and we probably continue down towards the 103 level. But some of the stocks that I was talking about for subscribers that we wanted to keep an eye on, this BLTI, for instance, BioLays Technology. I believe there's some kind of laser type of company, but it's got a 450,000 share average daily volume, which isn't a really terrific volume, but it's got a nice looking weekly chart. Looks like it could, if it could break some resistance up at this 610, 615 level, that it might be worth a shot, something to keep an eye on, and put a stop underneath one of these higher lows if it goes. Eli Lilly, I've been talking about, has this. Look at the. It's first of all, it's a defensive stock, a drug play. If you take a look at, it broke a 10-year downtrend line a couple months ago, and when we look at the weekly time frame, we can see that it's been a case of, over the last 10 years, if they didn't scare you out on the way down, they probably wore you out over the last 2 years as it's built this base. Well, it showed some strength on some volume, and if we just kind of zoom in on about this area now, and you can see it's got a decent looking weekly chart. If we go down to the daily time frame, it's been trying to hold on near this 50-day moving average. It's been trying to break some resistance in this area as well. It's not holding on to it though. We can see there's a clear area, and it's been 3780 to 3790 has been the resistance in here. If Lilly can get above that level and you can get a higher, identify which higher low you want to use, here's a stock that pays a dividend of 5.3%. I think it's worth considering for a potential upside trade. I don't think that the danger with a dividend, especially a juicy one like that, is you convince yourself to hold a stock that's down 10% in 3 months, and you got to wait 12 months to get the 5%, so you're going to be net down. Don't get sucked in by the dividend, in other words, but instead look at it and say, hey, that's a nice little kicker, and maybe that prevents people from really selling it off because they want to hold on to their dividend. But I'd keep an eye on Eli Lilly still. We were looking at BEAV, B-E-A-V. This is B-E Aerospace. A decent looking weekly chart here that's kind of just gone neutral more than anything, but it has been acting constructive in here. So BEAV has been a little bit choppier maybe. It looked like it tried to get going here today, but it broke back down below the volume weighted average price. It broke back down below. It didn't quite break down. I think this is really, if you're in this one, your worst case stop's probably about 38.50. I thought we should start keeping an eye again on Dendrion. It's not quite ready yet, but here's a key level up near about 40, and this is just one to keep on your radar. It's back above the 5-day moving average. We don't have a pattern of higher highs and higher lows above a rising 5-day moving average, though. That's where we want to get a little bit more interested in the stock. Golar LNG. This stock has been in a big uptrend on the weekly chart. On the daily time frame, you can see it had a correction down to the 50-day moving average. This is the second one recently, and it had a nice tight consolidation yesterday afternoon. So I was talking about we could buy this thing above this little resistance here with a worst case stop near 31.50. Well, it took off out of the gate today and had a nice run, and then as it broke down below the volume weighted average price, that's where I think you want to, if you have a new position and it's working, and you got to hold on to those positions for. You have to hold on to those profits when you get them quickly on a long in the downtrending market environment. Soda is another one that it's trying to set back up. They had the earnings back here. We've still got this bigger level at 55, and this prior support has been acting as resistance. We've got a declining 10 and 20-day moving average. This is just one to keep an eye on. Let's see if this thing can recover, if we can get some higher highs and higher lows and get past this prior little support. This is a decent one maybe to the upside. The big winner, and a lot of people were all over it on Twitter that we were mentioning too, is ZAG. And ZAG has been, it's got a big short position in it. They make what some people consider, I think, a fad product, and that's where why these shorts are going after it. But the shorts are wrong. It doesn't matter what you think about their product or how foolish it may be. You get a combination of an uptrending stock with a big short position, and you can see some big upside like that. But it's the exception in this market. A lot of people are looking for the next zag and the next little stock that's going to continue to go. This isn't 3 months. This isn't 3 months ago when a lot of stocks like that were working. Where are we right now in the overall market environment? We're maybe trying to become a little bit more neutral here on the daily time frame, but we've got an economic world in turmoil on the macro basis. We've got a lot of issues that this market is dealing with, and it has to deal with them before it can move forward again. So anyways, that is going to wrap it up here. I don't see any questions, and at this point, now I'm done. So thank you for tuning in, and hope you're at least surviving in this market, if not thriving. Talk to you later in the week. Thanks.